The system is not working. And we could find elegant solutions, or the markets are just going to flail out of control, and we could see a really severe downside in equity prices and in all risk asset prices. I'm beginning to fantasize that the Federal Reserve may have to cut interest rates no later than July of this summer.
I'm pleased to be joined by Hugh Hendry, a very famous investor, former CIO and founder of Eclectica Asset Management. Now he hosts the Asset Capitalist podcast. We'll be talking about his work, his views on the world and the markets abroad and domestically. Hugh, welcome to the show. Good to see you. Fan of your work.
Thank you. I think you said famous. I think I would replace that with notorious. I think you said investor. I think I'd replace that with procrastinator fantasist.
You're a very humble man for someone who's accomplished so much in the investing world.
That's not what the girls say, I can tell you that.
One man's notoriety is another's fame. I just made that up. But regardless, we'll talk about your work. I want to talk about your views first. You know, I have a list of topics prepared, but what you told me offline just now, before we rolled the cameras 10 seconds ago, was very interesting. You said that America's playing the role of China in the 1920s. This is the climax that we're heading towards. This is obviously dramatic investment implications. Tell us what you mean by that.
Yeah, okay. Let's see if I can do it. It's not a sure. So I am very much preoccupied with this historical analogy with the 1920s, after the First World War, and of course predating that, you know, the century of America, in the coming out of the 19th century, resulted in the United States being the modern equivalent of what we've seen out of China the last 30 years. And what we've seen is actually an assault on the logic of economics. I hesitated. I was going to say the profession of economics. They're a bunch of charlatans. But if we were to be fair to economics, one could say rather grandly that it is the pursuit and the study of a system trying to establish, find, locate equilibrium. And within the arena of international trade, we have not seen the establishment of equilibrium now in over 30 years. And by that, I mean that China and other mercantilist nations have pretty consistently run substantial surpluses on their trade account versus their GDP, from the range of 2% to over 10% of GDP. So very, very substantial. And there is an old adage that trees, would you believe, trees do not grow to the sky? You know, they grow high. Some of them grow high, yes, but there is a finite process. And trade surpluses in a system which restores equilibrium, trade surpluses are typically met over time with an appreciation in the export nation's currency. And that is very much a good thing. It's a reward to that nation and their collective efforts, which have resulted in them exporting more than they import. And so the appreciation in the currency effectively makes their citizens richer relative to the rest of the world. And richer citizens tend to have a propensity to travel and to import more and more products. And richer citizens typically underwrite stronger domestic consumption. And again, that tends to bring in imports. And the boost to world, if you will, exports from the donor countries, from the deficit countries, once they receive that currency boost, which comes through higher exports, then you no longer have this anomaly of perpetual surpluses. Now, that's how the system is meant to work in theory. In practice, in the 1920s, the mechanism was that these perpetual and very substantial trade surpluses with America versus the rest of the world, but mostly with Europe, would result in the inflow of gold, a capital transfer of gold. And gold, very much during the period of the gold standard, gold was money which, when transferred to the United States, would be transferred to the banking vaults of the private banking sector, and it would constitute a liability, and it would encourage those banks to make loans. And so it would be a mechanism for a monetary boost to the United States economy. And later on in that decade, the New York Federal Reserve decided that the American economy was booming. That is correct. But because of the domestic strength of the US economy, the Federal Reserve immunizes an economics term, but they essentially prevented that monetary boost from actually reaching the real economy. So we all know that the US economy boomed in the 1920s, but under the prescription of an economic system seeking equilibrium, the United States economy should have boomed even more ferociously, and therefore created a demand for European products from European nations, which would have restored equilibrium. And that ultimately led to the demise of the gold standard in the early 1930s. And something very, very similar has been occurring this time around, where China and other nations have been, if you will, diverting the funds which would have appreciated their currency, made their citizens rich. And instead, the money has been used to buy US Treasury bonds. And what we see is that in the last 35 years, despite China growing from the absolute size of the Turkish economy today to the size of the entire European continent, so a fabulous achievement. Again, under the orthodoxy of economics, one would rationally have anticipated that the renminbi would have appreciated, Chinese citizens would be richer, and their demand for goods and services from the rest of the world would have expanded. That hasn't happened, and so it's left us with these ugly terms of these perpetual surpluses and a lack of, essentially a lack of demand. So these are the parallels which I see today.
Is the Chinese economy turning into a more consumerist economy, moving away from manufacturing, and ultimately would that have any impacts on global trade?
That's what we wish. I don't know who we are, but those seeking a restoration of equilibrium and not these perpetual surpluses, for that to happen, yes, you're correct. China would have to pivot, if you will, to consumption. Consumption in China as a percentage of GDP is lower than the Philippines. It is just an anomaly. It's very, very low when you exclude government transfers. The Chinese are resisting it. We know they're resisting it because the principal transmission mechanism would be a stronger renminbi, and instead we're seeing the opposite. And in fact, you chart reading, if you will, navel gazing would suggest that it's on a precipice. We've seen profound and historically very, very significant weakness versus the yen versus the dollar, and the yen versus the renminbi, and the chattering classes, if you will, from the global macro hedge fund community. Everyone is really now concerned about a big surge higher in the US dollar versus both the renminbi and the US and the Japanese yen.
I've heard someone who's sorry,
yeah.
Please continue.
No. Because it's not happening, it raises cause for concern.
I've heard someone tell me that he's concerned about the Japanese central bank selling treasuries to defend the yen, precisely as a result of what you're talking about. Is that in the cards? And if so, that would have dramatic impacts on not just yields, but also perhaps even equity markets in the US, would not?
Oh, there's substantial consequences. Whether that is the explanation, I beg to differ. I would suggest to you that the weakness from So this is I'm going to postulate. We can't prove this stuff. I did introduce myself as a fantasist. I'm sure your knowledgeable viewers will be familiar with the euro-dollar system, and the euro-dollar system effectively is an enormous dollar printing mechanism which exists outside the territory of the United States and outside, if you will, the sovereignty of the Federal Reserve. More dollars are created every single day outside America than within the US domestic banking system. And the greatest, if you will, source of that dollar printing is Tokyo and the very large money center banks in Tokyo. And again, there's a presumption on my part that Japan has labored. So we're pivoting back and forward, forgive me, from Japan and China. I believe they're kind of twin sisters in some respects. But I wish to say that, as we know, the Japanese economy has been moribund for 3 decades, and they've been subject to endless quantitative easing. And so the banks have accumulated quadrillions of banking reserves, which have sat there latent and unused. And there's a hypothesis that actually in the last 10 years, the Japanese banks actually use their banking reserves as collateral. So the Eurodollar system needs collateral. You have to present, think of it as being a pawnbroking shop. You go to the window, you present an asset, and the pawnbroker will consider your collateral and will then offer you dollars in exchange, and that creates new dollars. The collateral that the Japanese used were, if you will, JGB cash bills, and in return, they received dollars, okay? With those dollars, I wish to suggest to you that they funded enormous credit investment, credit expansion within China, that they funded the large Chinese manufacturing groups, building factories there, but more importantly or insidiously, probably a lot of that money funded the incredible bubble in Chinese property prices. And so kind of trying to seek credibility to my argument, one prominent source I would say to you is that you can almost name the day of the yen's untethering versus the dollar. The yen had sat for the best part of 3 decades at 110 versus the US dollar. Today it's 156. I'm saying to you, it became untethered once we started hearing about Evergrande and the blight, if you will, of what are now insolvent Chinese property companies. And so what happens in the pawn shop or the Eurodollar is that the counterparties to Japan's banking system are now saying, hey, I'm kind of uncomfortable with holding these Japanese government T-bills. And actually, I think I would prefer that you offer me some dollar collateral, which would be US securities. And as you have to respond to that, this is a daily operation. You are requested to go back to the collateral window daily. And what you're finding is that at the margin, there is a huge sale of yen and purchase of dollar. And I think that's why you're seeing this, what's becoming really quite an exponential weakness in the Japanese yen.
Okay. We're going to come back to the dollar in just a bit. I want to talk about the U.S. markets first. Hugh, one of your claims to fame was netting a significant amount of money during the last 2008 financial crisis. Correct me if I'm wrong, but I believe Eclectica Asset Management returned 31% during 2008. One of the bets you made was a steepening of the yield curve in 2007, the 10-year minus the 2-year. We're starting to see that again. Can you make similar parallels to right now? What the yield curve is doing right now to the beginning of 2007?
Yield curve is causing consternation for every intelligent person in the world of finance. Number one. Number two, again, as color with regard to who I am, I was someone that, for the most part, didn't make a lot of money. Like the normal year for me would be, 1 to 6%. But those years when something profoundly shocking happened, when you throw your hands up and you say, but who would have guessed that? Well, kind of that was me. So, 2007, 2008. I do fear that we are in the theater, we're kind of opening the doors to a theater of absurdity, of big, shocking market movements, perhaps on a scale of what we saw in 2008. Now, that in itself is ridiculous, but the engineering, the monetary plumbing of the world in the last 30 years is such that it's created a volatility machine. We now, as a matter of factual record, we have witnessed the Nasdaq crash, which began in March 2000 and caused a severe US recession. Okay. Statistically, I mean, you can say anything, but it's a kind of 1 in 100 year kind of occurrence. A major US index lost 80% of its value. That's very rare. Okay. And yet, fast forward 8 years later in 2008, and of course we saw the S&P and it lost 65% of its value, peak to trough. Again, you'd subscribe that to being a 1 in 100 year, and yet we got two within 10 years. And of course, then we had COVID. So now we've had three 1 in 100 year events. And I think that's evidence that the system has become profoundly leveraged. And therefore, when it does move, the movements are amplified. Now, again, what I want to say to you is the source of all of that. I wish, asset prices have been on a tear for the best part of 4 decades. And house prices it's the common refrain at a social gathering, at a dinner party, etc. Everyone talks about either their private equity portfolio, the stock market, Nvidia, and house prices. Of course, recently, no one's really gloating about their last house purchase. But we've gone from an entrepreneurial society to one which speculates on higher asset prices. And I'd say to you, again, I wish to come back and I wish to say to you, that's because of the engineering of the international trade, that the perpetual generation of trade surpluses has created profound surplus savings, which have been reinvested into United States assets. And I wish to say to you, almost like the Chinese Communist Party and the higher echelons of Wall Street are together. Both parties make money at the same time. And I wish that we could put an end to it, because we got opiate. More people died of opiate abuse last year in the United States than cars, automobile accidents. This is extraordinary. The system is not working. And we could find elegant solutions, or the markets are just going to flail out of control, and we could see a really severe downside in equity prices and in all risk asset prices.
So just to sum up your thesis, correct me if I'm wrong here, but are you saying that this correction has to happen because asset prices are in a bubble already and that there just needs to be a due correction? Or is there some external catalyst, either from a geopolitical shock or the Federal Reserve making a wrong move or something else?
Oh, there's always something. There's always something else. But what I'm audaciously trying to suggest is that the rise of risk asset prices, from the S&P to private equity market valuations, have been simultaneous with the rise of the Chinese economy, from being absolutely tiny, the size of Turkey, to the size of the European continent. I'm saying to you that the mechanism which generated that, I mean, I shudder to say the economic prosperity in mainland China. I wish to say that prosperity has actually been transferred and translated into higher asset prices. And I wish to suggest that here we are now. And yes, the first quarter GDP out of China was better. Excuse me as I yawn. What is statistically now understood is that the Chinese economy is losing momentum, that the levers of growth now seem modest, and it may have a period of retrenchment. And what I'm saying is, if that happens, you're taking the juice, you're unplugging the liquidity from the spigot, if you will, which inflated asset prices. So you asked me about yield curves, you asked me about the Federal Reserve. So here we are in mid-April, and this year, the last 4 months, the markets have effectively had to remove the promise, the expectation of interest rate cuts by the Federal Reserve this year. We started with a lot programmed, and it's just about being eliminated. Okay, that's what markets do. They receive and they adapt to information. The US economy has been way stronger than certainly I imagined. Okay, I wish to suggest to you that And again, as a fantasist, and as a fantasist trying to look at where I can put on trades which really cost me nothing, but if I'm right, the returns are preposterously high. I'm beginning to fantasize that the Federal Reserve may have to cut interest rates no later than July of this summer. Now, that is completely unexpected. If there's a probability in the rates market, it's less than 20%. So I'm kind of overdoing it. It's saying completely unexpected. It's a low probability event because why would
Why
they
do
cut?
they? Yeah,
Why would
exactly.
they
Why
cut?
the inflation's still hot and the stock markets haven't crashed yet.
Exactly. So, and Jay Powell only yesterday said, inflation's proving a lot more stubborn. And it may be making, I mean, he effectively said, look, we're not cutting rates. Okay. But economics is all about taking your last comment and making you eat it. Yeah. And so we had a very similar situation in the summer of the late summer, autumn of 1998, with the whole internet extravaganza and telephone companies, laying down fiber optics and, like roadworks in every major metropolis. The US economy was booming, absolutely booming. And the Federal Reserve cut interest rates. Um, and and why? It cut interest rates because there was a huge crisis in Asia. The currencies of Thailand to Taiwan to South Korea all fell precipitously. And it also coincided with something very large in the system breaking, which was the LTCM, a very leveraged Nobel laureate sponsored hedge fund. And the Federal Reserve subjugated the absolute strength of the US economy, domestic economy, which necessitated probably higher interest rates. And the Federal Reserve said, I'm sorry, but we've become like James Bond and we have to save the rest of the world. And that created this preposterously like exponential leap in US equities and then they crashed. Yeah. I think that there are some enormous moves coming through. I mean, the S&P is down like less than 5% from its high, likewise NASDAQ. So it's not necessarily equities, but what's happening in the world of credit and volatility and currencies, it looks like there's an astonishing sovereign credit reappraisal. And mark my word, if we see dollar yen 160, 165 and going higher, if we see the renminbi, the Chinese currency, kind of being unshackled and weakening towards the 8 level, I think the Federal Reserve will cut interest rates regardless of the strength of the United States economy. And so I think, and again, I only think that will happen because stocks may have a 20-25% correction between now and some point in the summer. And I think the Federal Reserve would cut interest rates. So I want to be out of the stock market. I want to be out of risk. It's been profoundly rewarding for the last 6 months. And I'm kind of saying, you know what? I'm going to bet that I can. Maybe I'm wrong. I'm wrong about many, many things. But my speculation is I think it could fall 20-25%. People would be terrified. And I think the Federal Reserve would cut. And then people go, but you guys are crazy. The domestic economy is on a rip. And you'd see another huge bounce in Nvidia et al. So I'm a fantasist, but that's how I'm kind of trying to role play April, May, June, and July.
I have an economic fantasy I'd like you to address in just a minute, but you brought up risk off. So 20-25% correction possibly by this summer in stocks. Your risk off. Where would you go is my question. Now, Hugh, you've previously said on another podcast, and you've used a very colorful words to describe gold as stupid and preposterous. Why is my question? The gold asset itself has been seen as a safe haven hedge against volatility, if you want to call it that, by some people, not everyone. Warren Buffett doesn't like gold, to each their own. You wouldn't go there as a hedge?
So many things going on. My first reputational positive trade was in the first year of my hedge fund, and I captured the emerging bull market in gold in the calendar year 2003. I made 50% from my hedge fund, my deceased hedge fund. Uh, I I jokingly refer to gold as stupid. Like, why would you wish to own gold. You wish to own things with a positive carry and which are um, participating in the onward march of prosperity. And I believe there is still much prosperity ahead of us. So why would I want to own gold? Uh, it's a safeguard. Yeah, okay, it's a safeguard. You could have sat with gold from 1980 um, to the year 2003, and the gold price fell from 850 to $300, and the stock market, the US S&P, I think, went up almost tenfold. So safe, but very painfully safe. But the events that I'm talking about, I'm folding my money, I'm doubling my money, and I'm putting it into my pocket, and I'm leaving the casino. And I'm like, you know what? I'm going to take lunch over here. I might take a nice glass of red wine, and if the cards fall my way, I'm going to come back. I'm going to take the cash out of my pocket, and I'm going to try and buy risk assets again. So gold is infected by risk. If you own gold as a hedge for what happened in 2008. Initially, it was profoundly painful. There was almost a 50% correction in the price of gold from, I want to say, July 2008 to October, November 2008. And no one can withstand that kind of short-term decline. And then lastly, I want to say that gold, of course, we can't let gold go by without mentioning Bitcoin. I've been uh, I'm more in favor of Bitcoin tactically for a very, very asinine reason. And the asinine reason is that I think Bitcoin does everything that gold does. And I think it probably has some extra advantages. It doesn't have the history of gold. So we've got to weigh that in the balance. But today, I want to say the total capitalization of the gold market must be $17 trillion. And the total capitalization of the Bitcoin market, not the crypto, not all the silly stuff, but the Bitcoin market is around $2 trillion. And until I think we are going to see those capitalizations, which are like here, and I think they're going to come a lot closer in value. So I think with whatever's going to happen, that I think Bitcoin will continue to outperform gold until those capitalizations are more closely aligned. And then finally, the only market that seems to be awake just now, that where there's professionals who have a palpable sense of fear, is Bitcoin. I mean, Bitcoin's down 20% from its peak. Nasdaq's down like 4.5%, and people like smoking cigarettes. They're like, should we buy? Should we day trade Nvidia today? And Bitcoin is like, wow, like we've just made a lot of money. There's a lot of turbulence and storms picking up within the engineering and the plumbing financial system. Again, a lot of volatility coming through currencies. And some smart people, and the smart people I say today are kind of aggressively cautious. And the aggressively cautious people, I think, can be found in Bitcoin because people have sold it down 20%. So I think it's front running what may happen in other risk markets.
If you believe or if you speculate that we could get a correction in the stock markets this summer, would that not mean Bitcoin would also correct by several times more because of the higher beta, given that Bitcoin will continue its correlation with the Nasdaq?
Maybe. I mean, I don't believe in anything, but maybe. But I mean, talk of correlation, David. I mean, Nasdaq's down 5 and Bitcoin's down 20. So, like from a relative starting point today, where do I feel more comfortable, Bitcoin or Nasdaq? I feel like I've had 20%. I mean, if Nasdaq fell 20%, I'd be kind of cautiously trying to buy it down 25 or something. So I think actually Bitcoin is ahead. It's had a deeper correction than what we may see visit other asset classes.
How much would you hold in Bitcoin? Suppose you had $100 million. How much of that would you allocate to Bitcoin?
Well, up until my little wobble, I was kind of like, so you said 100 million. I'd have been 20 million in Nasdaq, if you will, tech stocks. And I'd have been, depending on your risk tolerance, anywhere between 20 and 40 million in Bitcoin. And then I would have, in a 100 million portfolio, I would have destroyed about 2 or 3 million buying leaps, 1 year forward options at the money on 30-year US Treasury prices, the TLT. Um, that's been I've been so wrong on that trade. But again, to reiterate, what I've been doing is buying options which still have a lot of life, but they've been marked to zero because they've just been the wrong timing. But anyway, if you get a 20-25% correction in equity markets, I think that you'd breathe life into that. And then finally, I've been $100 million long and 100 million, if you will, equivalent short either the Japanese yen or the Chinese renminbi. Today, I'm saying that I would be zero in equities and 10, so I'd be, zero in equities and maybe 10, $15 million in Bitcoin. I'd still have the currency. And I certainly would be, I'd probably be adding to my leaps in TLT.
Just because you brought up shorting the Japanese yen and renminbi, I'm curious, Hugh. We've all in school studied Black Wednesday. If somebody like George Soros came along today and tried to short a currency and attack it, like he did with the pound, is that still possible today? Could he do that with Japan, for example?
I mean, as wonderful as George is, and of course the evergreen Stan the Legend, Stan Druckenmiller, is really his trade with George, kind of like pushing him. Um, they were they were aligned to where the market was going. Yeah, it wasn't individual actors. Sometimes, many times, I'm called contrarian, and that's a very odd moniker for an odd person like me because I'm trend following. And where someone like Soros and the genius of Stan make money is where the marketplace becomes contrarian and imposes its accepted belief system, which is in contrast to the prevailing trend. Yeah. I mean, there's a really large hedge fund group just now in London, Ruffer, that I know well, and they've got a really good track record of 2008 and back, in 2000 with Nasdaq. They've had a really good record of calling crashes. Now they've been like hopelessly 2 years early, and they're out there. But where I take odds with them is that they are long the yen. They believe the yen's going to appreciate. That's been a really, really bad trade. And so, if you will, the yen has been trending very significantly weaker. And these very, very intelligent people that I respect, I'm not saying anything in disrespect to Ruffer in London, but I'm saying it shows you what I call the conceit and the arrogance. They have developed a belief system in London that the yen should appreciate. And it's caused them to lose money because they're betting against the trend. So I raise that because Soros was very much, I'm talking to myself, forgive me, but I guess there was no trend when Soros had the sterling trade because it was in a band. But it was wonderful, so there was a permitted band like we see in the Chinese renminbi versus the US dollar today. And it had permitted movements. And so you knew your downside. Your downside was the government guaranteed your downside. It was maybe 2% on a day. But if the peg broke, boom, you make 40%. That's just asymmetric. That's how you become a legend in macro.
The economic fantasy that I wanted to pitch you is the Goldilocks scenario that people were talking about. So the Goldilocks scenario is the Fed controlling inflation without causing a recession. How likely is that, do you think?
I don't think you'll see 2% inflation in America for 2 years. I'm
Okay.
2 for 2. And so I think the Fed is stymied, if you will, by the stubborn nature of inflation. And I think inflation is stubborn because fiscal policy worked. Yeah, so I keep talking to you about this malign influence of these trade surplus nations, principally China. A very, very good way of dealing with that would have been America to have had today's fiscal policy. Now I know there's everyone is right wing and everyone wants to wear a hair shirt and the size of government is bad. I hear that. But actually, there's so many deficiencies in the American economy, from health to education to infrastructure. Um, and this policy of actually subsidizing to have high tech manufacturing actually conducted in skill and excellence centers in America and not Taiwan, the amount of jobs and economic momentum that that brings, and it gets funded by essentially the nations running the surpluses. They kept sending the money. The US government did not wish to spend it. And so the money was deployed in speculative ventures, bidding up asset prices. So actually, again, we keep dovetailing and trying to pick out points from the historic past. But there's another kind of analogy, which is the fiscal policy, which kind of allowed the US economy to boom between 1982 and 1987. Yeah. Um, Interest rates kind of reached a plateau and came down slowly, but the fiscal thing really pushed the US economy. I fear that this volatility machine of the stock market and other risk assets may intervene and terminate some of the length of this great prosperous GDP expansion that we're seeing. But the economy is strong. And the economy is strong because after 35, 40 years, I don't care if they're Democrats or Republicans, but someone finally worked it out. Don't do tax cuts. Just subsidize Intel and TSMC and everyone else to build, $10 billion manufacturing facilities in America. Bravo.
Speaking of inflation, so you don't think inflation is going to come down to 2% in the next 2 years? What about longer term? One theme I've heard, Hugh, is that the advent of AI is long-term deflationary, meaning that it will bring technological costs down. Now, it also does a couple of things. One, we may see more layoffs in the foreseeable future. But number two, it's expected to boost global GDP by, according to Goldman Sachs, an order of 7%. A lot of trends and forces working out. What is going to happen to economic growth, productivity, and ultimately inflation as more AI is adopted? Hugh.
Are we really quoting Goldman Sachs?
I just read one report. I gotta throw it out there.
You may as well quote, I don't know, some like cartoon or something. They're fantasies. They're fantasies.
Sure.
Well done them. Well done them. There's nothing I can add. AI is extraordinary, and is moving so fast. The adoption rate, will be half the time that the internet adoption was, and it's just happening. But we're talking about the future course of US prices and arguably global prices. And I keep talking about the descent in the value of the Japanese yen. And I fear that may tip the balance and the Chinese currency may weaken. Okay. And again, I try to suggest to you that over the last, since NAFTA, which was 1994, the North American Free Trade Agreement with Canada, United States, and Mexico, China devalued its currency as a riposte to that to protect itself. And its currency since 1994 to the present day has weakened. I think it was, it's weakened. Not materially, but again, it should have appreciated. And that's the malign factor, which has boosted asset prices everywhere. But if we're talking about, I think NAFTA, we were 635. I think we were 635 red cabbage renminbi to buy $1. Today it's like 730. So you need more currency. Forgive me, I refer to it as red cabbage. But if we're talking about the renminbi trading 820, 850, do you know what I'm saying? I'm saying that an $18 trillion economy, which is hyper competitive, which subsidizes manufacturing, will actually get cheaper and cheaper versus the US and the European economy. That is profoundly deflationary. And I think that will not be permitted to happen. And I actually think that here we're getting closer to the 100-year anniversary of the crisis of 29 and 1930. And I'm saying to myself, maybe we have to reset currencies and currency global standards every 100 years because the world will not be allowed to endure substantial currency weakness out of China. Again,
Reset currency. What does that look like, Hugh?
um, you know what? I don't know.
Okay.
It's a redesign, but in terms of uh, what that looked like previously, we had a gold standard, and then it was, it created a shocking policy prescription which led to a depression, and it was abandoned. It was then replaced with Bretton Woods. And Bretton Woods really was replaced 9 years later by a matrix of private sector banks creating what I refer to as Eurodollar. And Eurodollar is the creation of money by presenting good, sound collateral that people will actually just invent money and give the money on the basis of your collateral. And so we're presently in a world where it's the dollar. If we had the gold standard in the 1920s, then clearly it's dollar treasury collateral standard. I'm sure someone can make that cuter. Um, and people are beginning to question the veracity, the robustness of US treasuries. And so I think there's going to be moves afoot to change that. We could keep the existing system, but it's going to need sovereign heads of state and very, very wise people to sit down and try and invent a new system. But I could change it immediately by abolishing the free right to sovereign nations to move capital around the world. Now, if the US closed its financial account or it imposed a levy, and so if you're the Chinese, what's called SAFE, the sovereign asset fund that lies within the central bank and which owns, I don't know, 7 trillion US dollars. If it said, actually, we're going to charge you 3% every year, yeah, China would still hold them, but it may be calcitrant to do more. That would stop all of this asset inflation. But the reason it doesn't happen is Wall Street. Remember, Wall Street and the Chinese Communist Party are like just different sides of the same coin. They both profit. They both create rising asset prices. And Wall Street finances politicians, and politicians are not going to vote for it. So the best that we can do in this world just now is the fiscal policy of subsidizing the transfer of high technology jobs and capital into the United States.
I've heard that subsidies of high tech and perhaps even the greenification of the economy, which is a separate issue, is unproductive. It's just inflationary in the short term, causing more debt to pile onto the U.S. balance sheet, and really ultimately it should be left to the private sector to sort out. How would you respond to that?
Yeah, there's and like every complex argument, there are great avenues of truth to that. When I say subsidy, I'm not saying that the government should give you a check and reduce the cost of your Tesla. I mean, they've already pulled back on that, or your solar panels. That those economic commercial decisions are best left to private sector agents working in their own best interest. But I do believe it requires a sovereign government intervention in terms of fiscal policy, given the malign effect of persistent trade surpluses. The fact that the Chinese will not allow their currency to appreciate means that the US government should be targeting the expansion of high-tech manufacturing activities within its own sovereignty. And I'd go further and I'd say that they should be replacing a lot of the aging infrastructure from airports to schools to highways. It will be funded by the mercantilist nations outside America.
Okay. The antithesis to the dollar-backed system that you talked about earlier is de-dollarization, which I believe you called on another media site a fantasy as well. Why is it that you think we're not going to get massive de-dollarization soon and have everyone move to either one of the BRICS nations or something else?
Okay, so I'm China, um, and for 35 years, my currency has weakened and I've gained a competitive advantage.
Yeah.
Okay, so now I now want to be the reserve currency. What happens with the reserve currency? Your currency appreciates.
Yes.
Okay? They don't want that to happen. So then, and chickens don't vote for Thanksgiving or Christmas, turkeys rather. So that alone means it's not going to happen. Secondly, uh, the dollar is the hegemon because I've just sent iron ore from my mine in Brazil. Okay. And I've accepted renminbi. Okay. Because we're now on a renminbi standard. Yeah. We're fantasizing. So I've sent you my iron ore and you've sent me renminbi. I'm like, this is why I call it red cabbage. What am I going to do with red cabbage in Rio de Janeiro? Okay. What are my options? Okay, maybe I could buy a property in China. You're not allowed. Maybe I could buy equities. It's kind of difficult. Maybe I could private equity. Yeah, it's kind of difficult. Maybe I put the money on deposit in a Chinese bank. It's kind of difficult. They've got a closed capital account. So it's blinking impossible. A, they don't want it, and B, it's blinking impossible. And again, like I've just received $100 million, right? Do I really want to put that money into the Chinese stock market? The US is the best of the bad. You know, it's got good functioning, transparent contract law. It's got an excellent judiciary system. Do they get things wrong? Yes. You know, it has sovereign stability. Yeah, and it has profoundly deep, liquid markets where you can not only buy but you can sell. I need my 100 million. Boom, back to you, low cost. So, is that is the Brazilian real going to replace the dollar? No. Is the Chinese currency going to replace the dollar? No. Is the Russian ruble going to replace the dollar? No. Is the South African blinking rand going to? I mean, do you hear how blinking preposterous this is?
Okay. One final question on this, and I want to move on and finish off and talk about you. Actually, there's speculation that these countries in the BRICS will create their own common currency. All right, this is another fantasy. I'm not saying it's happening. We're fantasizing here. Okay, let's address this fantasy. I know individually, maybe not compete with the dollar, but perhaps they'll find some common currency whereby they can trade with and de-dollarize. Right, end of the petrodollar, end of the dollar-backed reserve currency system. No.
So again, I'm a fantasist, okay, but
all right.
I want to say I'm a damn sharp, clever, smart, intelligent fantasist, okay, right? So like, I really don't want to waste precious energy on responding to something which is just cloud cuckoo. Let me do it in one shot.
Sure.
So you create a common currency, yeah. So you become the federal states of America, or you become continental Europe, the European, sovereignty. And what happens?
It may not, by the way, it may not be like a euro. It might be just like a commodity backed some sort of thing, that they can use. Yeah, right. Right. Yeah.
It comes back. The principal root failure of the system is, let's say it's Russia, South Africa, Brazil, China. Who am I missing? India, right? Okay.
Yeah.
And India and Brazil, forgive me, and China are booming, and they need to manage their currency. They need higher interest rates. And Brazil is in the toilet. Poor Brazil. I mean, I'm picking on, I don't mean to, I'm just
yeah.
selecting. But yeah, Brazil was in recession. Okay. And so when you have a common currency, you've got no sovereignty as a nation on the ability to set your interest rates. So Brazil is in a really, and sometimes, the vicissitudes of life, they visit Brazil. Right? And so Brazil is really having a tough time. I'm the president. I'm coming up for re-election. Normally, I'd phone the central bank. We'd be cutting interest rates, and we would have monetary policy which would accommodate the particular circumstances in Brazil. But guess what? I gave up my sovereignty to the Chinese, to the Indians, et al. And so I'm stuck. So again, as a sovereign leader, am I really going to give up the sovereignty of my monetary policy and therefore the ability to perhaps influence the political and election cycle in my country? Not going to happen.
Fair enough. It's not comparable to the Eurozone. I want to talk about investing strategy and finish off here. If you were to restart, let's say, Eclectica Asset Management, or just open a new fund, suppose you wanted to do that today, Would you do anything differently? Suppose you had $100 million of capital to deploy. Would you think differently? Would you act differently, knowing what you know now?
Um, so some people, like, maybe it's the first time you see me, and they'll go and look at my record and they go, the guy's got a big mouth and a mediocre record. For the record, I compounded at 7% per annum over 15 years. 7, not 17, not 70. Kind of really boring. But what the natives don't understand is my assignment was that my returns had to have almost zero correlation with every other risk asset. Yeah.
Mm-hmm.
And like if risk assets fell, I had to make money. So when you put those two preconditions onto that, 7% is kind of not bad. Can you imagine you had a life and fire and automobile insurance contract, and rather than you having to pay those bills, it paid you 7% a year.
Yeah.
And if your car was in an accident, it paid you out. That was me. Okay. And in terms of crazy young me today speaking to very, very conservative old me from the past.
Mm-hmm.
See what I did there?
Yeah, I see.
Okay, so if you're setting up a hedge fund today,
yeah.
good luck. It's really, really hard. You will succeed in the same manner that it's been true for all the other years. Your first year has to be spectacular. I made 50%. And I got 15 years. I got the tenure to do it again and again and again, something I loved doing until it became less than joyful. So if I'm a kid and 100 million or 20 million, I've got to be seeking the most volatile and trending asset class in the world. And I've got to own lots of it.
Which is what today?
It's probably still Bitcoin.
Okay. Would there be something you said your mandate, one of your mandates was to diversify or find something uncorrelated with everything else? What would that be today? Anything you would add that you think could boost your Sharpe ratio with very little correlation with anything else?
Shut up, no? Sharpe ratio is like, there's a lot of professional people going, Sharpe ratio, like, it's just one damn statistic. Albeit saying, I mean, heavens, if you've been long the Mexican dollar and short the dollar,
yeah,
for the last 18 months, your Sharpe ratio is like, maybe 2. It's been so a Sharpe ratio is when you have a trend with very little volatility. In fact, forget about the Mexican peso. The S&P from 2013 to 2019, the Sharpe ratio just being long equities was astonishingly high. I think it would be greater than 1. Write in and tell me I'm a bozo. But the instruction and my advice was, in your first year, you can't sit there going, oh, my Sharpe ratio this, and I'm orthogonal, and I'm a diversifier. In your first year, if you want to have a second year, you've got to have outrageously good returns. This is a really, really tough competitive environment. If you sit there and you're up 4, 5, 6%, and with a really good Sharpe ratio, people are like, yeah, call me in 5 years' time.
Yeah, well, that wouldn't that mentality encourage a lot of excessive risk taking, perhaps more leverage than one would like?
Welcome to the casino, David. I mean, we live in a world today where I'm an asset manager gatherer. Heads I win, tails I win. You, the client, who the hell are you? You're like, right. If you see the size of my boat, you don't even have a boat. Like. The rent that's being Wall Street is the Communist Party. Elite universities are so expensive because it's the rent to make sure that your kids go into Wall Street or into other, asset speculative endeavors. And everyone is closed out. We got to burn it down. We got to burn it down. And I think the temperature is getting warmer. This thing's like, and I'm going to say again, like, if you believe that China is now plateauing, and I think a plateau, it may draw comparison with Japan in the last 20, 30 years, but it's a permanently higher plateau of prosperity, but you've taken out the delta, the positive rate of change. If that happens, the outlook for risk asset prices like US stocks over the next 20 years, just with that condition, you go from like here to like, to flat.
Wealth management. People should know that before you started your own firm, right? You worked at a number of other firms, Credit Suisse, for example, Bailey Gifford, for example. Someone watching this right now in college wants to break out into the wealth management industry today or the next couple of years. Any advice? I know it's a very broad question, but what should they do? What should
Well,
they learn? Who should they
well,
network with?
I mean, so with the prevailing status quo, which is international trade. Forgive me for being boring, but
Sure.
it's really boring, but it truly underwrites the rise in asset prices. So if that status quo is not going to be ripped apart, I think it's going to be ripped apart. But if the status quo prevails, then kids have got to find themselves an occupation which is remunerated on the basis of higher asset prices. Yeah. Um, and and good luck with that because everyone's worked that out. Everyone wants that gig. It's not impossible, but it's hard. And I look back at my life, and there were pivot points where just good things unexpectedly came and rescued or accentuated my position. And I call it serendipity. But what is serendipity? I don't know. Like there seems to be that the more energy you try and more positive energy you discharge into the universe, kind of like someone puts a hand around you, someone gets you eventually, and good things happen. But on the other hand, if you believe China has plateaued. If you believe that the whole currency system of the world is going to be reevaluated, um, and and you lead to this kind of flat asset environment, I would say to you, you don't want to be in Wall Street. But watch China. If that thing really starts to if the currency really starts uh, to appreciate, then to consider. Again, I think um, with this whole right hemisphere, the artistic side, the thing that's very powerful, but culturally we're trained to like not trust it. I still think the future is. I'd be encouraging kids to be in entertainment. Um, like when you look at New York was like we're talking about the rise of China, America in the 19th century, and very much the zenith was the 1920s with all that amazing architecture. And New York stands as a testimony to the profound entrepreneurial skillship of that era, as does Paris from another era, as does London from another era, as does Venice from another era. And if we live 300 years more in the future, I think people will look at LA and say, "Wow, that was the epicenter." We have these things. There's like 4 billion smartphones. Look, my battery's working, but if it wasn't working, I still touch the screen. I'm like, feed me, give me content, anything. And I mean, we're doing it here. People are watching us on their screen. Hello, I'm the guy inside the phone. And LA is changing rapidly. Even the fashion, the Paris Fashion Week, there's more and more. All the creative industries are going to they're going to be collected in LA. So I'm a big one obviously for entertainment.
Wow, that's very unconventional advice. But suppose somebody wants to go into the field. Suppose somebody wants to apply to your fund. All right. Some kid wants to be an intern or an analyst, and he says to you, Hugh, can I work for you? What are you asking him during the interview?
I, Let me tell you, I am so bad at hiring people. I would never. I've now given power of attorney away to others smarter than me. So let me tell you the common problem I made.
Yeah.
I I was a magpie. A magpie, they say, can see its reflection in a shiny object, and so they fly around town and they see old-fashioned milk tops or badges or whatever, and they take it to their nest, and they're in the nest going, "Oh, look at me, who's a pretty boy," kind of thing. And I'd have other magpies in my nest, so I used to employ people who were very much in my own image. And then a very wise person sat me down one day and said, "You know what? We've got Crazy You covered. Like we've so got that, and actually we'll be more powerful if we can align people with special but very different talents, and together there would be a very, very exciting synergy." So um, like I say, I've got to decline to answer that because I'm not good.
Okay, fair enough. Well, it's very much of a privilege to meet you finally, Hugh, after years of following your work. Where can we follow your work now? Where can we learn more about you and study and hear about your thoughts?
Yeah, that's very kind. So I am the asset capitalist. I think you got to get high to see the future, you know. And I have a Patreon and a Substack thing out there. I'm Hendry Hendry, which is like a dry hen underscore Hugh on the old X space, the Twitter space. Um, you know, you can join me on my glorious journey in St. Bart's on Instagram, if you wish. And of course, I have a YouTube podcast, The Asset Capitalist. Um, less less output recently because it's becoming a passion project. I just kind of want to speak to people that kind of, you know, that stimulate me, but it's out there. So there you go.
Okay. All right. Very good. We'll put those links in the description down below. So make sure to check out Hugh there. Thank you very much again, Hugh. I hope to see you again soon. Thank you.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.